Hello and welcome to another edition of the MarketMinder Minute. I'm Casey Ellis, and today I'll be discussing a psychological concept that prevents many investors from reaching their long-term goals: myopic loss aversion. Myopic loss aversion is a core part of prospect theory discovered by two psychologists in a Nobel Prize-winning study. Essentially, they found that investors hate losses to an irrational degree, roughly 2.5 times as much as they appreciate the same size gain. These findings dash the long-held perception of humans as strictly rational actors who coolly weigh pros and cons before choosing. The study showed the pain of losing is so powerful, folks were willing to risk a highly probable total loss in exchange for the slightest possibility they wouldn't lose anything. Conversely, the joy of winning wasn't enough to take chance of walking away empty-handed. And this concept doesn't just live in academia. You can see it in politics, too. When a law is proposed that would redistribute wealth, property rights, or other things from one group to the other, the folks losing shout the loudest. They organize get-out-the-vote drives. They have rallies. The fire is in their bellies. For the winners, it's less so. So how does all of this relate to the stock market? Well, remember, myopic loss aversion amounts to investors feeling the pain of loss 2.5 times as much as they appreciate the equivalent gain. A falling stock market is more painful than an equivalent gain is enjoyable, so the loss feels more severe. And all of this has a tendency to cause folks to sell lower after buying higher, to react suddenly, swiftly, and yes, even at times irrationally, by selling when patiently holding may be the right action. When you're in stocks, your brain isn't always your friend. You have to manage what I would call the myopic monster within. In my 11 years in the business, I've seen it firsthand, and most advisors who have been in this industry for any length of time can attest to this too. Studies by independent third-party research firms like Dalbar's Quantitative Analysis of Investor Behavior or Morningstar's Investor Returns show investors frequently do the opposite of what they should. You can question the specific numbers these studies show, but the available evidence suggests their conclusions are heading in the right direction. All too many folks fearfully sell when they shouldn't. They refrain from buying when they should get in, and many don't even select the right mix of investments because they fear losses more than they understand the power of compound gains. These emotional decisions have tremendously negative impacts on their long-term returns. Psychology and markets may not seem connected, but there is actually a long history of this. As legendary investor Benjamin Graham wrote decades ago, the investor's chief problem, even his worst enemy, is likely to be himself. While the investing world has evolved some since Graham wrote that phrase, human beings really haven't. Yes, technology is faster, trading costs are lower, online access is widespread, 24-hour news and online reporting and more make it so much easier for fear to become a factor. And make no mistake, our emotions have an outsized impact on returns. In increasing efficiency and ease, the industry's evolution has made it all the easier for an investor to blow himself or herself up. That's all for today. Thanks for tuning in to the MarketMinder Minute.